Good evening, Nathan Bray from ACY Securities. I'll be your host for this evening's webinar. I'm one of the senior account managers and trader trainers here at ACY. So this evening, we'll be going through and having a look at key elements to position trading. So keep in mind too, I'm just going to put this risk disclaimer up for you. This evening's webinar, obviously I don't know the attendees in details, all their personal financial situations. So as a result of our ASIC license, this evening's webinar will be just providing information and education about trading, and I won't be providing any personal advice or recommendations, which no doubt you can read in that disclaimer in front of you. Now you can see my ugly mug there on the right, so you know I'm a real person, but I guess the first portion of tonight's webinar will be talking about what is position trading. So position trading, we'll have a look at that in more detail. We'll go into how to identify key levels that a position trader may choose to use, and then we'll go in more detail and have a look at examples of recent key levels that the market has reached to give you a better explanation as to how to take advantage of those key levels and how they work as far as position trading goes. We'll also go in and have a look at the different types of entries position traders may use. So we'll also, I would like to do some trade size calculations, which will be super helpful if you're doing position trading to get an idea of what your risks might be and what your therefore rewards might be based on the strategy that you're going to implement. And then the final part really, it will be hunting for future setups. So putting some of what we're talking about into practice right now and getting a really good idea, I guess, as to how to implement those strategies. So let's open this up for you right this moment. So what is position trading? So position trading, look, it's a strategy where a trading position is held for a long period of time. This is probably the easiest way to explain it. So generally, you're looking at, say, weeks, or months to achieve your profit objective. So you're trying to take a position in the market for a longer period of time, as opposed to just perhaps intraday trading or getting in and out and using the volatility, the immediate volatility in the market. You're looking at taking a position and trading that either up or down for a longer period of time. In position trading, a trader would generally sort of have a long-term thinking, and the position will be held for a prolonged period of time, irrespective of what the short-term gyrations are doing. As I just mentioned, the positions could be either going long, as in buying the asset first and then selling at a profit, and short. So that is selling the asset first, selling something you don't own, and in effect, you're borrowing the instrument and the amount, and you're selling it straight away in the market. And then the idea is that that will then go down, and you can buy it back at a cheaper price. Finally, traders generally use long-term charts as a result. So we'll focus in on how to look for trades using, say, weekly and monthly charts. We'll also use our, say, potentially you could use a 4-hour or a daily as well for your entry. But determining your position and then looking for your entry, they're probably the two key facets of getting involved in position trading. Now, the examples of position trading that I'm going to cover for you right now. So we'll go and have a look at some examples. There's sort of 3 different examples we'll look at now. So first of all, you've got trend trading, so trading in line with a trend. Then we'll have a look at range trading. So that is when different instruments might trade in a longer term range. And we'll look at, say, an example on oil. It's very topical at the moment, so we'll go in and look at that. And then I guess a third one we'll look at is position trading, where your entry in analysis is going to be based on, say, sudden fundamental changes that might occur, and then looking technically for changes of direction to go in line with that fundamental change. So, for example, a war breaks out in a particular region, and then you see that currency in that region maybe change direction on the longer term. Okay, things like those types of examples, and then you might take a position to go in and either buy or sell those instruments. So let's get out of this at the moment. I don't have any questions coming through at the moment. Just let me double check. No, there's no questions coming. I can see someone's typing one at present, but let me just get rid of this screen for you, and I'll bring up some charts, and we'll go in and we'll first of all have a look at this trend trading, and then some range trading, and then the directional changes that can occur. All right, so I'm going to put up some charts. Now, keep in mind, I'll let you know the timeframes. So we'll be looking at, say, a monthly, weekly, and daily type charts. I want to start off, and tonight is really about looking at indices and commodities. So that will be the two key areas I'm going to focus on. I may bring up, just for ease of showing examples, some currencies, but we'll really stick to indices, commodities, and go from there. So to start off with, let's start with indices. Let's start with one of the biggest stock market indices in the world. Let's start with the S&P 500. So trend trading. So what I've got here is a chart of the weekly chart. So each candle is 1 week. So we're going right back to this resistance level here. So where are we? We're back in, say, 2020. So we're a few years ago. So I'm going to go in and show you that right now. And you can see here, this is where I've drawn this black line in. This is resistance. We can see, if you can't see a little bit further back, because I want to use this as an example, but this is an area that price failed from at around this 3,230, and then it became resistance. Okay, in other words, the market, no one wanted to pay much more than that sort of level overall for the S&P 500. Price then broke through. So you might look at that and say it's putting in these higher bottoms, higher tops. So you might determine that as on the weekly chart to be the trend. So price is moving up, but then you're up here saying to yourself, well, do I really want to buy up here? Is the trend going to continue? Where do I want to look for entry points as a trend trader taking a positional type approach? So if you see here, price goes up and then it comes all the way back down a number of weeks later, a few months later, and you find that is previous resistance going to become support? All right, and you can see it right here. We also get a hammer form right on previous weekly resistance becoming support. So you might look at this key area, and I'll just highlight it a little bit for you where I'm talking about. So right here, you might be someone saying, okay, well, if I believe fundamentally that the trend is going up, then I might say to myself, okay, as a trend trader, if price comes down and shows me that it's holding at previous resistance, or the roof becomes the floor, then I might say to myself, all right, the next candle, if it moves higher than this week, okay, I might look at an entry point, and whatever your entry criteria is. So it's quite a simple approach. Risk-wise, let's say you're entering here, you might say, I want to put it, below the recent low point. So you're risking a number of points. Okay, so from 3,000, say 250 or 3,270. Okay, you're willing to risk perhaps all the way down to 3,079, like a couple of hundred pips, to give it some room. If, for example, because you don't know that this is literally becoming support. Now, keep in mind, on a full lot, it's pretty simple to calculate. So the good thing about indices is each point, okay, is going to be about $1. Okay, so you're looking at risking $1. So if you're willing to risk, say, a couple of hundred pips, then you're realizing that that's risking a couple of $100, which means you've got to have a target in place where you're saying to yourself, all right, I want to target at maybe 2 for 1 or 3 for 1 or whatever it is. So you need to be therefore targeting sort of up to say 600 pips to give you that nice 3 for 1 relationship. So you can put in your target. Let's say it's 3,270. So we need to go from 2 to 4 to 670 or 3,700. Okay, and as you can see, price comes up, comes back down. It's moving higher. That resistance is becoming support. It goes back up to almost previous resistance. It's quite amazing a few weeks later. And then we get this sell-off and it comes all the way back down and retests that major support level. So let's say you didn't get in here as a positional trader. Your belief is, or your view is, that it's going, the trend is going higher, and that's what you're putting this strategy in place for, to trade in line with that trend. It comes back down, retests, and you can see there it really does hold. Now, that provides you an opportunity by seeing that to get some vindication to say, okay, this support level at present is holding, it's being retested, and it's still holding weeks later. You could, depending on your strategy, even enter into another trade if you wanted to. Or if you missed out on it there, you might feel like when it retests and hold again, you could look for an entry. And we'll get into entries in just a moment. So as we can see with the longer term trend, so keep in mind from your entry here, week 1, you got week 2, week 3, week 4, week 5, and you're pretty much back to where you started. So to take a position for that longer term trend, and then we get this big reversal candle right off support here, and then it really starts to move. Okay, and suddenly you're, from your entry points, doesn't take a great deal of time, and suddenly you're up, 600, you're up to a potential target. So this is the idea, I guess, with this positional trading, is you can stay in this for a few months. You've made 3 times your risk, for example, and then you could exit. Okay. However, if you're then looking for another entry point, and this isn't certainly a trading style that requires you to sit there and watch the markets every day, as I mentioned. You're almost watching price. You can check it, I guess, each day, or you can check it weekly, because you've got your strategy in place in line with your financial view. Now, let's say we missed out on that opportunity, and it's quite a simple process. We can just go in and say the previous resistance level. I'll just target that in for you. It's not exact, but if you just hover over it, it tells you the exact number there. If you don't have this indicator or this setup, please feel free to contact me here at ACY. I'll be happy to get these indicators out, which are super handy for you to look at for your trading. And they're available to all our registered clients. It doesn't mean you've got a fund. So as you can see, this resistance, so price starts to move up, and look what happens. Price comes down and exactly the same scenario occurs. We get previous resistance becoming support. Okay, so you could have that as your strategy. If I'm keeping an eye looking for an entry, it comes down, it literally does almost exactly the same thing. Okay, so these types of patterns are going to occur over and over again, whether it be on the short-term trading that you're doing, or if you're positional trading and looking for longer-term trades. So from there, as we move higher, you're going to be therefore waiting almost for corrections to occur. Now, keep in mind, there are other tools that you could use on the way up. So you could go in and say, well, price may not come down exactly if it's in a stronger uptrend, mightn't come down exactly to previous resistance and become support. So from these levels, I can almost go into a bottom period to the most recent top and use the fib tool and get in based perhaps on a retracement level. So here, for example, I've got in the 79% retracement is where it comes down to. Okay, and just as price gets there, if you start to see it reverse, whatever your entry criteria is, and we'll get into some of those as well, you could use that for the pullback. Because keep in mind, if you missed out on buying, for example, something at $1 and it ran up to say $2, and then you think, I want to wait for it to come back down to $1, that may not happen. It may, come back down to say $1.30. people who missed out think, oh, well, that was cheap considering it was at $2. So you've got to remember the fear and greed motion of using this Fibonacci tool is about allowing you to wait for a pullback and try and calculate where a high probability zone might be for you to look for an entry. Okay, so that again, these things are all going to be covered in Duncan Cooper's webinars. He's going to go through all of these tools as well. And in saying that, as it moves higher, we'll just go through just a couple more here so you can see resistance level can almost do exactly the same thing. So from this high, how far does it pull back? Now, in saying that, you're going to have to adjust your risk. So that's the other part of it too, because you might have to say to yourself, well, if it pulls back on a 79% retracement, I'll put my stop underneath, say, the previous resistance becoming support. That might be your approach, and therefore you need to calculate that risk and therefore lock in that type of reward. The other thing you might do with trend trading is you're using these tools to really get an idea of things like your trailing stop losses as well. So, or taking partial profit or getting risk out of your trade. Okay, so looking at this trade, for example, where you're getting in here, you might look at that and say, well, once I achieve my risk target. So let's say I was, risking 300 pips, and once it's up 300 pips, I'm going to bring my stop to break even, or I'm going to bring my stop to break even and sell a third of my position and take that as sort of locked in profit. All right. So there's a number of strategies that can be used, and remember, these things are going to take time to achieve. So in this case here, from perhaps an entry point, you're up about 300 pips within, maybe 3 or 4 weeks. So then you might say, well, I'll bring my stop to break even, or I might take some partial profits. Now, these are questions that you need to start to consider how you're going to play that, because in this example here, price comes all the way back down, right, to where, just where you would have entered. So it would have taken you out at break even. So with these longer term trades, do you want to allow yourself more room for the trade to work and to try and avoid those types of circumstances? It's completely up to you. I think with your positional trades, you're in a position where you've got to really try and lock in your strategy, and your exit criteria really needs to be maybe to do with change of the market structure and things like that. To give you an example, so we're staying here on the S&P 500. Like if you're drawing in a trend line over the long term, and remember, this is over a number of years, you can see price kind of, it just has these higher levels of pullback. I'm just sort of drawing that in as a guide. You get this moment of correction, but it always comes back to the previous resistance, becoming support a fraction higher. You never get this actual break where it starts putting in lower lows until very recently. Okay, so if we have a look here, we're saying to ourselves that on the 16th of January here, 2022, so you can see here, we've literally got a break occur. So therefore, you might look at that and say to yourself, well, I've got a situation here where the actual overall long-term price structure has changed. Now, let's move on to the next form of trading. So I want to show you now, outside of your trend trading type approach, we'll look at this range trading. So if we look at range trading, I'm going to show you just a few examples. So let's I'll bring in a currency at this point. So the currency I'm going to use is we'll use the pound against the Norwegian krona. And I'm just going to bring this chart up on a weekly chart. So looking at this, you can see markets are going to spend some time going up. They're going to go trending up, as you can see, over long periods of time. They're going to go down, and they're also going to be periods where they're going to go sideways. Okay, so with that in mind, you can see with this currency pair, the British pound against the Norwegian krona, it's very much for the last sort of few years, because each one of these is a week. You can see it for yourself. There's these major levels of resistance, okay? And then there's these major levels of support. Now, there are a few instances where price gets down and actually breaks through, but it ends up at the end of the month closing back above that support level. So that's where I think this example is good, because it's critical that you have a strategy in place where you could say to yourself, every time it gets down to this level, I'm just going to buy it. But you can have these situations where you get these breaks through these levels, okay? And you're going to make sure that you've got your stops in place, or you've got lots of room on your margin to allow for these types of volatility to occur. But then once price settles back above that major level of support, price then starts to move back up again. And again, this is a good example of where you might use your Fibonacci. Okay, so you can use your Fib tool, and I'm on a weekly chart, and you might be looking for an entry point. And if you go to this bottom period here, it literally, look at that, it comes up to the 79% retracement level again. So even using your weekly chart, you can still, and you'll see it was previous levels before. So you can use these levels as well, and they're working in a sense when price is going sideways. Obviously, best used when price is actually either in a downtrend or an uptrend, because you're looking for either higher tops or lower bottoms. So to keep that in mind. All right, now from there, I'll get rid of that Fib tool for you. It's a pretty straightforward strategy here. You can see over the last few years, and remember, this is, they're means of exchange. So as far as currencies go, there's a point where it's just going to trade in these ranges. So it's very much, different to valuing say a stock, in that it's a means of exchange. So you get these really key levels. Suddenly it just becomes overbought. And or price can move all the way down to where it's, say, oversold, and that can present potentially some trading opportunities. You'll see recently the pound, during the crisis that's been going on throughout Eastern Europe, affecting Europe and the UK, price tried to get below this level. But looking at this range, you'll see now it could close this week back above it. You know what I mean? So this kind of level comes into play and is something to consider. And then it comes into, okay, what's my entry criteria? Let's look at another example while we're here. So let's look at, one of the things everyone's talking about at the moment, which is looking at oil. So I'm going to have a look here at oil and show you the ranges. I mean, some people say, well, if oil's down in around $20, then, that's cheap. If it gets up to, 100 plus, then that they might see that as more expensive. And if we're looking at, price of oil over the last, this is since 2011. Okay, so every time price got up around this, 110 plus dollars. In this case, the exact level is $114 there. So if price gets up to that resistance level, okay, you can see it's failed numerous times. Sometimes it doesn't even quite get up there. Okay, and that's in 2013, and this is again in 2012. So price very recently, with all of the inflation issues, geopolitical issues, we've got supply issues, all kinds of things occurring, and people being very, very concerned about oil. You'll notice that this resistance still came into play. Okay, so price literally got up there. So you may have found very recently, and one that we're looking at, where price failed back underneath there. So if you're range trading, it allows you potentially to get risk out of your trade. So you might say, all right, well, if it fails back underneath there, I might have a strategy where I'm risking to the most recent high point. Okay, up here, each one's a point. And then if it fails back underneath, once I'm down an equal amount, which it has done, then you can say, right, I'll get risk out of that trade, and you can take that position now to see what it's going to do. If you didn't see it, well, maybe that could be a level up here that you sort of paint in and say to yourself, well, if price gets back up there and I see a failure and I see an entry point, then again, that's, that's a positional type scenario using your monthly chart. All right, yeah, a couple of questions coming through just about that on oil as to where my view is on oil. But as you can imagine right now, if I have to just look at things technically, and I can see that, and the really simple tool too is that your MACD is just crossed up. It's putting in these higher tops and bottoms. We had a lot of volatility. So I will be keeping an eye on that exact same level, just to give you an example from a trading perspective of what you can do. And then it all comes down to whether price gets there and whether that entry sets up. So I'll bring up on the screen now just an example of a tool that we have for this type of thing called the live interactive trading feed. Now there's a webinar on this. I'm just going to bring it across on the screen for you. It's using a free platform called Telegram. And we have a private live interactive trading feed on that from ACY Securities. And you'll see Duncan Cooper, for example, here. He's going to do some webinars that you can have a really good idea of where key levels might be in the market, if that's how you're choosing to trade. And really short videos for about 1:46. So he's doing a breakdown of key levels on the Aussie. He'll do both shorter term trades and highlight really long term key levels as well. So this could be something that's going to come out to you live. Okay, so that's the type of tool that's available to our active funded trading clients that are registered with ACY. So please don't hesitate to shoot me through an email, and I can get you an invite out, and you can get these short videos and analysis sent out to you live when price is reaching some of these longer term key levels, as well as shorter term. Because keep in mind, you can trade it. The time frame you stay in the trade is completely up to you. You might use the longer term key levels as a short term trading opportunity as well. So keep that in mind. It's a great new product here. So you'll see different key levels sent out to you either from Duncan Cooper, who hosts our webinar series, myself, and you'll also have ones come out from Lenny Volpicella, who is the team leader on our global desk here at ACY. So you can see that there's also scenarios where price has reached a key level, but the question then is it going to fail or is it going to go higher? And I think you'll find right now that price is up around that major resistance level on the pound yen. And then I guess it really does come down to what type of entry criteria you're going to have. And that's what I'm going to jump into next for you. So let me get rid of this for you. Now, we were looking at oil. Now, let's move on to another commodity. So I want to now give you another approach where we said we're looking for trades to set up where you get a change of direction occur that also coincides with changes in, say, fundamental information. So to show you that, we're going to use, let's have a look at gold. So an analysis you might do is say, okay, I'll go to a monthly chart on gold. And I can see this is the 2011 highest point it ever got to. So I'll put that line in. And you can see over the last, remember, this is a monthly chart. So this is going from 2020 right through to now. So about 2 years. Gold's really been, had this big run up at the start of COVID, and then it really has been consolidating or going sideways. Notice how that previous high here became the highest point it could get to before it failed again and just consolidated in this range, okay? However, we now are asking the question, well, do I just want to hold a trade for a year or 2 years or 6 months and it sort of goes sideways? So what I might be looking at is the bigger picture. So price now has broken above, okay, that 2011 high. So I'm now going to go to, say, the weekly chart, just to get a better idea of it. So you'll notice where that resistance level, which is that 2011 highest point, actually started to become support. So that's where a trader might look at that from a positional perspective and say, oh, okay, people are now, like, the old roof is becoming the floor. The buyers who weren't interested in buying up here, previously, they're suddenly holding up here, and the sellers, they're holding on too. So you end up in this uptrend occurring out of this consolidation zone. Then you have a look at something like inflation, and gold is largely regarded as an inflation hedge. Okay, so people look at this idea that, all right, if things are going to cost me more because inflation is going up, which it is, next year, maybe I need to get in now and hold something that's also going to go up in value, so that I could sell that and buy whatever it is. Let's say I'm buying widgets and I need to buy them from China, and because of inflation, they're getting more expensive. So what I might do is park my money in gold, right? And therefore, if gold is an inflation hedge, then it's going to go up, say, in line or in value with inflation. So I'm going to end up with enough to pay more for those widgets, say, next year, right? So this is sort of one of the commodities, if commodities are rising, that people might park their money in, and therefore that's sort of how it can be used, especially if people are buying different commodities and things like that. Throw in the fact that we've got uncertainty with COVID, and you throw in the fact that you've got uncertainty with what's going on overseas and other commodities like oil, and a potential war breaking out and so forth. So you've got this change occurring fundamentally in both inflation and in both money printing, and which is one of the key causes of inflation, increasing money supply. You're inflating it like a balloon, right? So then suddenly this becomes technically attractive as well. So if I go to a daily chart, then you can see it really clearly here. That previous resistance or highest point it got to in 2011, that is really becoming support there. Okay, so if I draw in a trend line, I'm a positional trader, for example. I might say, well, and what I'm talking about now is the entry. So I'm saying to myself, I want it to show me that it is now in an uptrend and it has broken out and it is holding. So I could use that support, and I could say, right, once price on a particular day shows me it's breaking this trend, changing the trend, I could look at, putting a stop below this low here and targeting whatever it is up there, okay, or whatever it is my trading strategy will be. So trend line breaks, maybe even going down to a lower time frame like a 4 hourly, and look for your MACD. See how your MACD is crossing up here, okay, right around where it's almost going breaking. You might say, well, the MACD's crossed up, so you're moving average, convergence, divergence. So the people are willing to pay more, and the averages, the short-term averages is rising against the longer term. Okay, so it's all happening now, and we get a trend line break, and it's holding at a major support level. So you might say to yourself, they might be the criteria that I could use. Now, there are lots of criteria you can use, and we've also done a partnership with Capitalize here at ACY, which allows you, if you want to really automate things, not even watch it daily and weekly, can even create your own strategy, or utilize another strategy and be able to have it automatically take trades for you. If that's of interest to you, then please contact your ACY account manager. And it's quite an interesting partnership that we've set up with Capitalize to allow for that automated trend type trading approach, or major, whatever it is that you want to lock in your strategy. And yeah, it certainly has been an interesting product. So it really comes down to when you're looking for your entry, okay, you need to, a few things I would say is make sure you're consistent, okay, and make sure that you've tested your strategy. You know, if this is what you're going to do, the attitude would be, if I saw this type of setup 10 times, I don't have a crystal ball, no one does, but I'm trying to say, am I improving my levels of probability? And if I did this 10 times, you know, with only risking, say, $500, but targeting $1,500, I mean, how many times do I need to be right? And that's where this type of trading strategy, both positionally, gives you a lot more time to consider your entry point. Some people may come into a trade and just say, well, when it gets to a critical level, it's in line with the trend, I'll just put in a 100 pip stop. Give it some room, because remember, markets can be volatile, things can happen, and as soon as I reach 100 pips in profit, that's it. I'm going to get risk out of the trade. And once I reach, like, you can have a really simplified approach. And remember, this could take days or weeks for the trade to start to really show you which direction that it's moving in. And if you're doing that across, you know, a whole variety of different trades, then you get to put yourself in an opportunity to diversify yourself, but using your technicals and your fundamentals together. All right, let's go in and have a look at your trade size calculation. I'll keep it really simple, I guess, tonight, but the idea is, in indices, if, for example, you're looking at, say, the NASDAQ, I'll bring the NASDAQ up and just show a couple of examples recently, and we'll have a look right now at a couple of examples as well. You can see where I was looking, this is on a daily chart now. So we did get this overall change in price structure. So very similar to the S&P 500 I was showing you. So I'll go to a weekly chart. And you can see how very similar, where price was moving up, higher bottoms, higher tops, higher bottoms. You know, it was this constant move up until we got this area here where we actually started to get in lower bottoms occurring. So this resistance level, okay, was starting to be broken, but it was kind of still holding, and then boom, right there, you get a break and a hold where there's a change in direction occurring. So if you're looking to take a position, we look at that resistance. Does price go up and test it? And if I've got a change of view, maybe interest rates are being starting to rise, or there's talk of it, there's inflation issues occurring, and they're going to affect tech stocks, or whatever the fundamental view is. So then you can start to technically look for your position. So if I go now to the daily, that's where I'd lock this level in. So this previous level of resistance, previous level of support was becoming resistance, and it really did trade down over, you know, a good level here. So if you're looking at a number of points, so from 13,000, let's just call it 13,000 at this stage, and 11, and you're looking at, say, 14,700, you're looking right up here to 15,000. So it's already 2,000 point move, okay, that price has come down to. So if you're risking, you know, 100 points or $100 up here with the potential, you know, of making, say, 2,000 points, okay, on the way down, that might be favorable. But then we see price come all the way back up and retest it. So when it starts to show you, and I know our own chief economist here, Clifford Bennett, was really pointing out how this price structure had changed. There was a lot of fundamental things that have changed that are affecting stocks. It came back up, and therefore I was listening to that fundamental analysis. I had this line drawn in. I said, right, if it starts to fail here, if I get a setup here, you know, I might have a look at up to going in line with this change of structure and change of things occurring fundamentally that might affect price to, rather than being in this long-term uptrend, it might start to either correct sideways or start in a downtrend. And you can see from this level here already, it's been you know, a good sort of solid 1,000 point move down. So even using your daily charts. So if I then go into my 4 hourly again for an entry, you can see price goes up, reaches that resistance point. We have our MACD on the 4 hourly cross down. if we could put in our trend line, very similar to what we were doing previously, not drawing that the perfect trend line. Hang on, let's just move it to there. Right around this region here, you start to say, well, my MACD's actually crossed down. It's failed back up at a major resistance point. The current overall trend now has changed. And there's lots of things coming out that are different, as in, you know, they're talking about tapering, they're talking about raising interest rates. These things, as Clifford's explained to us many times, isn't great for tech stocks, okay, or the difference between your value and your growth stocks, that kind of thing. And you can see, you can look for entry points. If you missed out on that entry point, perhaps you could look at this most recent bottom area here. And you can see again, this magical 79% retracement level, okay, comes all the way back up here. And very similarly, you get this change of direction. I could draw in another trend line. And remember, I'm doing all of this just on a 4-hourly chart, okay? And we get this move down. So what I'm trying to illustrate here is your approach positionally. Remember, this is probably days apart. So this first change of direction is occurring 31st of the 3rd, and then this next one's occurring the 5th of the 4th. Okay, so you've got you know, a good sort of working week in there between entry points. So again, it's not a trading strategy. You've got to sit there and watch consistently. If you're checking in a week and you see it at a key level, or you get on our live interactive feed, the Telegram's going to come through. It's going to alert you technically. And then if you're watching Clifford's updates, you know, in the mornings, which is fantastic, he's going to be pointing this out. So fundamentally to what could change. So that allows traders who are trying to combine a few different things and look for major changes of direction to be able to use that type of strategy in line with their trading. Okay, question coming through is just, does this, you know, what I'm showing seems to be, does it work on other instruments as well? And I think the answer to that is you're going to find these types of patterns appearing across all sorts of instruments. Okay, and I mean, if I was to, for example, I'll look at a recent trade just to give you an idea, without going all too hippie on you too, like this idea of as above, so below. You know, something the ancient Egyptians talking about. I know Fibonacci can be seen all around the world in different formats. But if we zoomed in on, say, a 15-minute chart on, say, this New Zealand US dollar, you'll see this region, this major level of daily resistance. And we're seeing this similar type of approach. This was when they came out and announced an interest rate hike, up to a double interest rate hike, as in a 50 basis points. You know, double what they were expecting or forecasting. And it reached this major level of resistance, and we get a trend line break, and then we get this trend down. So it's like you're seeing these similar types of patterns occurring, whether it's occurring, you know, on the bigger picture, which might suit your time frame and your approach, or whether we're literally here where we're looking at, you know, it reached this major resistance point, trend line break, MACD cross. Same thing happened about, you know, 5 or 6 hours later, okay, right around a key fundamental announcement. So what you're seeing here too is the pivots. If that's something that you guys are interested in, let me know. We can set that up for you on your platform. It's available to all of our registered clients as well. So I feel like what we've done so far, I'd like to thank you all for all of your attention. I'll put this chart back now on the back on gold, because I love gold. And I'm looking at any more questions that come through. If they come through after or over the next few minutes, I'll get back to you all, or you can just email me. So feel free to email me at nathan.bray@acy.com. Now, keep in mind some of the things I've talked about this evening that you may not be familiar with. We also have like a 12 to 16 part experience where for all of our live registered clients, okay, who are funded, they get access to the whole course. So they can watch the recordings, or they can go in live with Duncan and obviously be able to interact and ask questions. But your account manager will be more than happy to assist you if, for example, you like the look of the Telegram, or you want to learn more about positional trading, if you want to set up your demo account, or you just want to start taking really small positions, micro positions on these positional trades, they'll be able to assist you and or go into the webinars, and Duncan will be more than happy to assist you there. But other than that, I'd like to thank everybody for their time. Have yourselves a happy Easter break, and which I know a lot of people are happy because we've got 3 short weeks in a row in a way, with Anzac Day and a few other and the Easter break. So please enjoy them, be safe, and I look forward to speaking to you all at our next webinar. Thank you very much.